So welcome everyone to the panel on innovating for financial health, our FinTechs addressing the challenges, our policymakers addressing the challenges, our banks addressing the challenges. We've gathered a pretty fascinating panel here. It's a mix of academics, practitioners, and policymakers who have been working in this space for quite a bit of time. Very briefly, I have Shlomo Benartzi from UCLA. I have Ryan Falvey from Financial Venture Studio. I have Adrian Harris from Financial Health Network. And I have Kenneth Singleton from Stanford University. What we are going to do is have each of the panelists talk a little bit about how they've thought about issues related to the topic for about 10 minutes. They'll also give you a longer introduction about themselves and how they have been engaged in this space. And once they have expressed what they have thought about in this space for 10 minutes each, we'll have a discussion to flesh out some of the issues for about another 30 to 40 minutes. And then my plan is to open for Q&A, open discussion with all of you. So that's the plan, and with that, I'll ask Shlomo to come in and kick us off. Thank you.
Okay, here we go. So I'm Shlomo Benartzi, probably most known for helping people save for retirement, the work I've done with Richard Taylor on Save More Tomorrow, which now the best guesstimate we have has helped 16 million Americans save more in 401k plans. But this is about the future, not the past. So let me talk about FinTech, an area that I find fascinating. And I think the question whether the innovation actually is addressing the challenges or not is an interesting one. And I'm going to offer obviously two perspectives, because such an important question cannot have a simple answer of yes period or no period. But I'll start with the yes. Maybe there's a lot that is being done that's really moving the needle in terms of financial wellness. I'm going to talk about one experiment that I've done with a FinTech company called Acorns. How many are familiar with Acorns? Quite a bit. So they started by helping people invest, not save, invest the change. So you go to Starbucks, you pay $4.60 for horrible coffee in a paper cup. I was actually offered to invest in Starbucks decades ago and decided not to, because nobody would pay $4 for horrible coffee. I was obviously wrong. They rounded up to $5, the 40 cents goes actually into an investment account. So their special thing was that you could actually buy fractional shares and make it actually efficient to the point where they can actually help people invest by just using the spare change. Then, of course, once you do that and you succeed, you very quickly find out that people don't save much. So it's a really nice behavioral insight to get people to start saving and investing, especially those who don't have access anymore to a 401k or a retirement plan, kind of the gig economy, the Uber drivers and so on. So we need people to maybe put aside money on a periodic basis. And originally, the idea was that they do so on a monthly basis or on a weekly basis. The experiment we ran was embarrassingly simple. We asked people to think of those amounts as a daily amount. And when you think about the $5 a day as a monthly amount, 7% have signed up to actually put this on an autopilot and save beyond just saving the change. Weekly amount, you do better, about 11% save. But we were quite shocked that when you call it $5 a day, 30% would sign up. Now, Acorns now has 6.2 million users. compliance doesn't allow me to talk about how many are saving more because of switching to daily, but you could figure out the back of the envelope calculations. So I would say that if you just look at kind of those kind of behavioral insights being scaled by fintech companies, moving the needle for literally millions of people at a time, and it took us literally 9 days from the day we kind of looked at the environment and thought about the experiment to the day it was in the field was 9 days. To the day we had more data than we needed to do the analysis was another 11 days. This was all done in 20 days. So I would say, obviously, FinTech is moving the needle in the right direction. We also looked at how it affected the have and have not. We're equally surprised. When you frame savings as a monthly amount, those who don't have a lot, who makes $25,000 a year or less, they find it very unattractive to save. Those who make a lot more, those who make 6 digits, 100,000 and more, they find it actually much easier to save. Now, you would have expected that gap to go down a bit in the savings behavior of the have and have not, but we never expected it to be completely eliminated when you frame things as a daily amount. So there's absolutely no difference in the saving behavior of the have and have not when you start thinking about it as a coffee a day or $5 a day. So based on that, I mean, hats off to the FinTech industry for really moving the needle. But obviously, things are not as simple, so I'm going to actually spend the second half of my little intro on why I think we're also failing miserably at the same time, we as, kind of the FinTech industry. And just 2 seconds of introduction, kind of background. I'm going to talk a lot about attention and the fact that you actually, when you have an information fire hose, as we have today, some of you might not be able to resist and check your phones while we're here, but those who would not, by the time we're done with this 2-hour session, you'll probably have 20 emails, 7 WhatsApps, 5 text messages, 3 calls that you missed, 5 alerts from the Ring security camera at your house, and of course I missed probably a few other types of information pieces you will have. And this virtually creates really attention scarcity because we're not capable of processing all the information that we get. And what does this have to do with FinTech? So I want to actually use 2 examples of how the lack of attention would play and what would be the impact on financial health or financial wellness. So let's assume my car broke down and I have no money, okay? And I go to Google. As soon as you put my car broke down, it actually suggests, and I have no money, okay? Now, literally, wasn't, in the old days, you go to a payday lender or, you ask your family and someone gives you a bit of money. Wasn't a great system, but let's see what happens in the digital age. You would think it would be a lot more efficient, but remember, there's no attention. So think for a second, who would be the #1 player in the Google search results? Someone who would pay a lot of money to grab your attention. How can they afford paying it? They got to rip off the customer. Now, and this is, I'm going to give some concrete examples. It's not about specific companies, so actually it's just the general theme of how things work. So the first one that would show up is car broke down, no money, we come to you, junk my car. Sounds good, easy. So we actually pretended to have a car that broke down, and we were offered right there $2,700 on a car that is actually worth $6,400. Now, this is how it works in the attention economy, right? If I want to be the first player on the Google search, I have to pay a lot of money, I have to make a lot of money, I have to give the customer a really bad deal. There's no way around it. My conclusion is there's a lot of good to be done, and I think some companies are certainly doing it. But there are also a lot of challenges in a world that lacks attention because someone has to pay the price to grab the attention. And if it's, the pay lenders being replaced by being number one on the Google search to offer you a really horrible deal when your car breaks. So I'll stop here. Thank you.
Hi, so my name's Ryan Falvey, and I'm with an investment fund called the Financial Venture Studio. And we invest in a lot of consumer fintech. Thankfully, none of the ones that just got mentioned just now, but a lot of others. And so I'll talk a little bit about kind of how we think about the market, kind of our approach. So he brought up a really good point. The financial services industry in this country is very expensive to operate in. And while those two examples highlighted kind of non-regulated banks or non-regulated entities, I guess Lemonade is a regulated entity, the vast majority of searches, so you search for credit cards, you're likely going to see a top 5 bank that dominates the credit card industry. You search for mortgages, you're going to see probably Quicken. Those search results cost hundreds of dollars for each of those clicks to get, and that's some digital. Google's slightly inferior to Facebook in acquiring users, and that's even more expensive on a per customer. And that doesn't get into arguably even more effective ways of reaching consumers, which are billboards, TV, direct mail, opening up branches in downtown urban areas that hundreds of thousands of people walk by a year and having them see your brand, sponsoring things like the Super Bowl, stadiums. Financial services is incredibly expensive to operate in. That's just acquiring customers. There's regulatory costs of doing this. There's labor. Financial service professionals tend to be relatively highly paid, especially if you're getting rid of a lot of the actual people who are touching a consumer on a day-to-day, your call center operators, your branch employees, your brokers. You're left with a relatively expensive labor force, not to mention if you're dealing with tech, that's also a relatively expensive labor force to operate in. And so FinTech, one of the things about them is these are relatively capital-intensive businesses for technology companies. And so when we're early stage investors, so we're usually the first money into a consumer financial technology company. They might have an idea, they might have something approximating a prototype, maybe they have customers, usually those customer numbers would be in the hundreds or thousands. And we're starting from the premise that if this idea is going to be successful, this company is going to have to raise hundreds of millions of dollars, maybe more, over the next 5 to 7 years. Both those examples that we saw right now, Lemonade and Acorns, are demonstrative of that. And both those companies have a long ways to go before they're kind of public companies and ready to kind of get to the scale that we think of as a financial institution. And so what we do is, when we're coming in, is we're assuming that the companies we invest in, we're not going to be able to provide them the capital to take it to the next level. We're assuming that they're going to need to get other investors in there in very, very short order. And so what we're trying to do is very quickly help entrepreneurs understand how to navigate the financial services industry in this country. And hopefully avoid buying a bunch of Facebook and Google ads right off the bat and maybe being the top result for a day or two and then dying. Because there's a lot of them kind of do that, maybe not as a compressed of a time frame as that indicates, but not much longer. And what we do is, so after we invest in our companies, is we put them through a program that tries to connect them to the kind of 3 kind of key stakeholder groups that we think are critical to build financial service companies. 4. Regulators and policymakers, other financial institutions. All those products you just saw, and every single company that we invest in leverages other financial institutions to make their products work. It's a highly networked environment. It's highly collaborative. Partnerships are critical to building these products at any scale, and those partnerships are actually really complicated to build and to develop. Media and influencers, A far more effective way than paying for users is to get other people to talk about your product and sell it. I don't know if you guys are familiar with the Kardashian family, but one of them is now a billionaire by creating a makeup line that she sold almost exclusively to her audience on Instagram. That is exactly how financial products are sold now too. Is if you can influence people on Instagram and Twitter and other places to buy your product, you will have the same, that's what drives kind of the viral growth. And there is very few examples that I can think of companies at early stages that did not leverage those same kind of dynamics of kind of the digital ecosystem, and that, you know, kind of staying forefront of people's attention to grow at that stage. And then the fourth group obviously is investors. If these are capital-intensive businesses, we need our companies to be able to raise money from other investors. And so what we do is we try to provide them capital to kind of get started. We try to connect them to that ecosystem, and then we try to give them advice on how to communicate with all those different stakeholders to be effective as they grow, so that they can be, you know, these very complex businesses that can talk to all the kind of constituent stakeholders that are critical to build a financial services company in this country. We do that through a programmatic approach. So we invest in companies, and then we work very closely with them for about 6 months. And during that 6 months, we're very intentionally introducing them to each of those stakeholder groups. So regulators and policymakers, media and influencers, other investors, and then partners. And then hopefully also helping them build some camaraderie with each other so they have other founders to bounce ideas off of and, you know, share what's working and what's not working. We do this because this allows us to optimize our own labor. So we're investing in a lot of companies, and we're usually coming in with relatively small amounts of capital and then quickly building on our positions. So our initial check size is usually about $100,000, and we'll scale that to about $1 million in our companies over the course of, you know, the first 12 months of our investment. So we're using this structure to really quickly get a sense of who's operating and who's executing, and essentially diligence our companies in this, you know, kind of intensive six month period. So it looks a little bit almost like my partner Tyler likes to refer to as kind of graduate school for FinTech. So we're not really focused on how to start a company. If anyone's familiar with, you know, companies like Y Combinator or other early stage accelerators are really helping startups get started. We're really taking companies that kind of have gotten started and really get them smarter about operating in the financial services industry. And then this is our portfolio, and I'll kind of pause here. Maybe I can call out a couple of companies that we think are doing some really compelling things to innovate around financial health and for really pro-consumer outcomes. Generally we're coming in really, really early with these companies, and hopefully they start growing very quickly after we invest. But a couple that are worth calling out. One is a similar, the example of Acorns is a company called Digit, in the bottom, this corner. Which helps people automatically save. They basically just look at your accounts and they look for money you might not miss and sweep it out. So I think if you look at how that might differentiate and kind of on that previous example of Acorns, what Digit is basically assumed is people don't want to even make that decision. So I'll just hook my account up and that algorithm will determine if there's money that I can save and sweep it out of my account for me. We have another company that does something very similar to that on the student loan side, a company called Pillar, which is kind of right above it. Student loans are an incredibly complex product. They've kind of been designed to be complex, unfortunately. And the one thing you can do that is kind of pay your student loans off as quickly as you can. Very few people do that. In fact, it's actually made difficult by the servicers, or to, join public service loan forgiveness programs and some of the other kind of government programs that are out there that are also highly ineffective because they've been made difficult by the servicers to participate in. So what Pillar does is try to automate that complexity. And we'll look and try to help you save more than you might otherwise on your student loans. And then also try to get you into the right kinds of programs to reduce the total cost of that loan over the life of your payment. We have a company called Flex, another really, really interesting one. Again, targeted at a relatively low income consumer. They do bi-weekly rental payments. So most people pay rent monthly. Very few people get paid monthly. Most people get paid every other week or maybe twice a month. So what Flex does is just simply joins those two payments together, and so that you're paying rent when you get paid. There are bi-weekly rental payment programs that many landlords run. One of the interesting things about it is that there's 26 biweekly periods in a year, but there are 24 half-monthly periods. So many of those programs that exist right now will just charge you, they'll just break your rent in half, and you're effectively not getting a biweekly, you're just paying an extra month of rent. Or many consumers will actually just pay a late fee, which is the largest source of profitability for many landlords. It's set by statute in many states. It can be as high as 15% of the outstanding principal, and that money just goes directly to the landlord. And there are plenty of renters who pay that every single month just because they're habitually short on cash. And so you can imagine you have a $1,000 monthly rent and you're paying it late every month, and that's and you're paying a $150 penalty per month. That's a significant amount of money. And so what this product does is it advances you the money you need for that second rental payment when it's when it would be due, and then it takes that out of your account when you get paid the next 2 weeks later. And so it's a loan product, and the loan would be basically about notionally would start about half of how much your rent is. But what's interesting is because of that differential between biweekly and bi-monthly, at the end of a year, you've transitioned somebody who's habitually behind in debt to having effectively a savings account because now they've put money in there. So it's a really interesting way to grow and a really compelling way of thinking about aligning the interests of a consumer with the startups' goals as they're trying to grow. And then maybe the last one is probably worth touching on is a company called Dave.com down in the corner. This is an overdraft protection product. And what this product does is, again, similar to the Digit, it looks at your account and looks when you might overdraw it, and then offers you the opportunity to advance up to $75 to avoid the overdraft. Company's grown ridiculously quickly. It became a unicorn, over the summer. It's worth over $1 billion. We've got millions and millions of users on the platform. One of the interesting things about this product is that the vast majority of people simply being alerted that they're going to get an overdraft never draw the money from Dave. They're paying $1 a month just to be told that they're going to overdraft, and they have enough control over the finances to avoid that overdraft from occurring. So it gives you a sense of how stacked the financial services industry is kind of against the consumer, that just simply telling somebody they're going to overdraft will prevent many of the overdrafts. And then the remaining ones, on average, the Dave advance is about $35. So it's not much, and it gets paid back about 2 days later. And then a consumer effectively pays a monthly subscription fee, which is about $1. And then they'll pay a little bit more if they want the money right away. So it's usually like a $3 or $4 fee if you want the money kind of instantly, which is related to the cost of actually providing that. And then they have a feature where you can kind of tip what you think it was worth. These are interesting products, and I think that last one is probably kind of a harbinger of maybe what you're going to hear a lot about in kind of consumer fintech and kind of fintech for financial health. Is there was a wave of companies, and Dave, in my opinion, is probably the most successful, but there are certainly others out there that are very similar and maybe even arguably a little bit ahead, who are really innovating in kind of this alternative liquidity space and kind of the alternative to a payday loan. And I think, I think for many people who have been using payday loan products, these have been seen as a better alternative. They're generally cheaper on an absolute dollar amount to the consumer. But if you think about it from an APR perspective, they still can be quite high. There's a lot of questions around how many consumers are using these. I mean, if you're using Dave and you're using Active Hours and you're using PayActive and 15 other ones simultaneously, I mean, are you really getting someone out of debt? So there's a bit of controversy in this space. And I think that might be, as you think kind of forward in fintech and on consumer innovations, where you'll probably hear a lot about over the next couple of years is, what happens when these business models start to get to scale, and what does that mean for the industry, and how should we be thinking about how we encourage innovation? But our next panelist is far more qualified to talk about that than me, so I'll hand it over to her.
I'm Adrian Harris. Just a little bit about my background. I started my career in derivatives pricing and Latin American M&A out of New York. From there, I went to the Obama Treasury Department, where I was a senior advisor to the Deputy Secretary, covering everything from FinTech to sanctions and CFIUS to housing finance reform. Then went to the White House, where I was a special assistant to President Obama, managing the financial services and housing finance reform portfolios. And then when the administration ended, I went to San Francisco and was a founding executive in an insurtech startup called States Title, which used machine learning to underwrite title insurance. We managed to grow that company from a seed stage company, which might attract an investor like Ryan, to now a very large insurance company. And then when that happened, I came to the University of Michigan, where I now teach grad school, FinTech entrepreneurship at the business school and the policy school. I also sit on the board of the Financial Health Network, as well as the boards of a number of FinTechs, and do my own angel investing, although a little bit more on the institutional and capital market side these days than the consumer side. So like my fellow panelists, I'll start sort of by answering our title question, and I think I'll answer it sort of similarly, which is to say we've made some progress on financial health and leveraging FinTech for financial health, but there's still a long way to go. In general, I would say FinTechs have enabled us to make the most progress along the road to financial health. Banks try to, but they've been somewhat less effective, and I'll talk about that shortly and why I think that is. And unfortunately, despite my background in policymaking, I'm going to say that policymakers have probably been the least effective cohort or set of stakeholders in advancing the financial health ball. But let me take a moment too and just remind us about the genesis of this thing we call FinTech, which, not 5 years ago was a sort of a very new term and now seems to be everywhere. But if you think back 9-10 years, or think back just before the financial crisis, we had this amazing moment in history where you had the financial crisis happening right about the same time that the iPhone was invented and smartphones started to proliferate. So you had this almost perfect moment in history for this new industry called FinTech and mobile finance to develop and blossom and have people start thinking about their financial health in a different way, because trust in banks was at a generational low. And now we had this new set of tools to help us think very differently about what we were doing with our money, both from a consumer standpoint, but also from a capital markets and institutional standpoint. Around the same time, we started just talking about these issues differently. So I think most people will remember the buzzwords really used to be financial inclusion, right? We would talk about the unbanked and the underbanked. And certainly in the US, we've come much more to talk about financial health. The threshold has moved because in the US, we don't have so many unbanked people as there are in other parts of the world. We might have more underbanked people, which is to say people who have to rely on alternative service providers, often predatory providers. But we started talking more about financial health as a new sort of baseline for how we think about consumer finance. Certainly in many parts of the world, financial inclusion, right? Just getting people into some sort of financial system, be it formal or informal, incumbent institutions or startups, is still sort of the relevant question. But I think it's worth remembering how that evolution has come about. And then I'd say this idea of financial health really caught on with this now very famous and often misquoted Federal Reserve statistic about 40% of Americans not being able to put together $400 in the case of an emergency without borrowing from a friend or family member or from a financial institution or selling something. So once that statistic proliferated out of the Fed, and I think through Atlantic Monthly and sort of on to everywhere from there, we started talking much more about financial health and FinTech and other solutions. And rightfully so, because I think it really was the financial crisis that highlighted for people across the income spectrum just how precarious the financial situation of many Americans, and indeed people around the world, really was. A couple of other things I'll say just to level set, and I'm going to talk a little bit more about FinTechs and incumbents and policymakers, but just because I can't help editorializing a little bit, there's no number of apps or programs or investments that will make up for people just not making enough, right? It doesn't matter how many cool things you have, and I think I'm like, because I can't help myself in playing with FinTechs, I'm like a customer of most of Ryan's investments because I love to see how they work. But if you don't make a living wage, and your basic expenses are more than you earn, there are just no apps, or there's no bank, or there's none of that that is going to help you find your way to financial health and stability. Seems very obvious, but I find it's often worth restating as we start talking about some of these topics. Next, I would say, even for those people who earn more than they spend on their basic expenses, there are all kinds of things in the traditional system, as Ryan mentioned, that are set up to help prevent people from becoming financially healthy. The rent one is a perfect example, right? Most people get 50% of their income on day one of the month, and 100% of their rent is due. And we know that the plurality of Americans pay at least 30% of their income in rent or in housing costs. And another proportion, I think it's a quarter, pay about half of their income in housing costs. So if you get half of your income on day one and all of your rent is due on day one, that's the ball game. Good luck eating, good luck putting gas in your car or taking the bus, right? Good luck with the vet bill and buying soccer cleats for Johnny, or whatever the set of basic expenses are. So it's worth remembering that even for people who make more than they spend, there are these things built into the system that really make it hard to become financially healthy. Another one of these things, and it's a particular bug up, I think, for many of us in the space, in the US, is the payments timing lag, right? You have money deposited in your bank, and it's 3 days before it's available to you. For many of us in this room, we have a buffer. And so that lag isn't a big deal, or we have enough in the bank that the bank sort of allows us to draw on that money before it's fully been processed and hit our account. But for most Americans, that's not true. That 3-day lag, and God help you if it's a weekend or a holiday, makes a huge difference, right? I get paid on day one, my bills are due on day one, but it's gonna be day 3 before those funds are available to me. So of course, what am I gonna do? I'm gonna go to a check casher and spend the money on fees there. I'm gonna overdraw. I'm gonna go to a payday lender. So I think it's easy for all of us to sit up here, and as we talk about those who are financially vulnerable and are working on their financial health, to think it's an issue about literacy or an issue about inclusion. Those really aren't the issues. I think most of these people are just making the best decision out of a set of bad options, and the system, again, as Ryan said, is not set up to be helpful for them. And these are all things that are fixable with the help of FinTech apps, or frankly, if policymakers would just make some very basic changes to the structure of our financial system. Third, I'd say financial health has become important, not just because of what we all went through with the financial crisis and how it coincided with the proliferation of smartphones, but I think we've come to realize that financial health is important no matter where you are on the income spectrum, right? It's easy to sit up and talk about financially vulnerable populations, but often I will give talks or sit on panels much like this one, and you've got a room of people who presumably, right, do okay for themselves, and my favorite talks are the ones I give to corporate executives, and what I do is I ask everybody to close their eyes, and I ask a bunch of questions about their finances, and I ask people to close their eyes because we all have like a little bit of shame about our personal finances often. But when you do that and you ask people to raise their hands about, who's behind in their retirement savings, often in very wealthy audiences, right, or who's struggling to figure out how they're going to pay for their kids to go to college and all of this stuff, you find that not just the financially vulnerable, but people all across the income spectrum struggle in some ways with financial health. Often with these wealthier audiences, you find two things. One, that they are underinsured or misinsured. They don't quite have the right types and amounts of insurance, and that estate planning is a mess, right? Those are often where sort of wealthier groups really struggle with their financial health, and I think that's worth talking about. So while we talk about the financially vulnerable, I think is the most important and sympathetic group, it's also worth noting that financial health is a problem that affects people across the income spectrum. So back to sort of our title question of are FinTechs advancing the ball, or banks and policymakers? I do agree. I think FinTechs and those that have been highlighted are doing a great deal to advance financial health. It is worth noting that many of these FinTechs still do require you to have a bank account or a credit card, right? They need something to link to. With few exceptions, they are built on this flawed financial infrastructure and require you to be linked into it. And so in some respects, they're getting a bit at a new audience, but they're maybe not making as much progress into audiences who don't have access to the formal financial system as we might hope that they would. So they're improving the financial health of people who probably had some baseline level of financial health, but they're not really getting to the most vulnerable populations as of yet. I think that's worth noting. They also, there's an issue, I think, of trust. I often talk about banks almost like I talk about Congress, right? Like everybody hates Congress, but they love their congressperson. Everybody hates banks, but people are strangely attached to their bank. And you might hate Wells Fargo or Bank of America or JP Morgan, but at least you know they're going to be around, and these apps often pop up. And for the average consumer, you might think, for all I know, this is like a couple of guys in their garage, and it actually might be, right? So there's a trust element there, I think, that goes along that makes FinTech, for the most vulnerable population, somewhat harder to accept versus a younger, probably more affluent audience, more tech-forward and first adopters. So then lastly, I'll say policymakers, as I said at the start, I think are in some ways, unfortunately, the biggest hindrance to financial health. And I don't think it's because they're malintended, obviously, and I want to be careful as I talk about sort of my former profession and lots of my friends and colleagues. But policymakers tend to be more focused on consumer protection, which is not the same as financial health, right? They are related and overlapping, but they are not the same. And the most stark example, and this is not a novel idea, many people have written about this and explored this, is an idea of APR, right? We think of APR as we think about the cost of credit, but for most consumers, they don't really think about the cost of credit that way, or they don't think about their money that way. They think about cash flow because they have to. And if you think about a very short-term lending product, right, even some of these new payday advance products or an overdraft lending product or a rent lending product, if you looked at these things in terms of APR, they might look ghastly, when in reality, they're very cheap and advantageous for consumers. So I think one of the things that policymakers struggle with is sort of finding this balance between ideas about consumer protection, some of which are a bit outdated given tech's entrance into financial services, and how to really think about consumer financial health. I think this is more true in the aftermath of the financial crisis, where there's a little bit of muscle memory and a knee-jerk about bad financial innovation, right? We tend to think of financial innovation as collateralized debt obligations and not as FinTech. And for policymakers, I think it's really important to assess the merits now of financial innovation and FinTech and what the outcomes are for consumers, maybe more so than using some of the metrics we've become accustomed to using as we think about consumer protection. I'll also say, and I think Ryan sort of alluded to this, we have a regulatory coordination issue. It used to be that banks had blocks and brick and mortar, and they still exist, and they're still good things for consumers, but now money and FinTech and financial services are borderless. So put aside just even in the US, where we've got 8 federal financial regulators, sort of depending on how you count, right? And 50 state banking and 50 state insurance regulators. But then when you're talking about FinTechs trying to move money across borders or being multinational corporations as they start to grow and mature, regulatory coordination is a place where policymakers just really haven't caught up to think about what finance is going to look like in the future, and I think that hinders consumer financial health as well. So I'll stop there and look forward to further discussion.
Great. Thank you. So I'm Ken Singleton from Stanford University. Some of you will know me from my previous work in credit, but over the last decade or so, I've shifted a lot of my own attention to impact investing and FinTech. We run an early stage We run an impact fund that does early stage investing in socially impactful companies. FinTech is one of the verticals, but we look at all verticals in the impact space. We've built up a portfolio now of 6-8 companies over the last 4 or 5 years. I have gotten much more involved in the FinTech space, getting data from some companies, although nothing to report yet today, and advising some FinTech companies. And I work with several venture capital firms that do investing in the FinTech space and help them sort out the pipeline and make their own investment decisions. What I'd like to do today is build a little bit on the comments that have preceded me and also sort of give us a little bit more of a sort of broader research focus about questions that I think are really quite intriguing that we're not maybe looking at enough yet that FinTech has raised in terms of the kind of questions that are posed to this panel. Let me say at the outset that I completely agree with the people who preceded me up here on the panel that FinTech has made great strides in having a positive impact on the lives of households, and as I'll speak more to this in a minute, also I think on small business. With better technology, we've lowered frictions, we've lowered transactions costs, we have a much deeper understanding of behavioral frictions and how to use that for good, and also associated network effects. And FinTech has really raised the awareness of the benefits of using broader alternative data sets to provide a better user service-oriented product. But the regulatory barriers that are still out there and the market structure that we see, I think continues to support a lot of costly suboptimal solutions for households and small businesses. And I want to talk a little bit about some of the business models out there and why I think we need to have the bar higher than where we are, and we have a long ways, I think, to go. I'll say also, and I'd like to toss this out, and hopefully Ryan at least, and maybe others can comment on this. I worry some about the core funding model that we're using in the FinTech space in terms of the incentives it creates for the behavior of companies or the nature of the business models that get reinforced through these funding models. And many of these FinTechs, frankly, are building their profit on the same frictions that we're striving to overcome or mitigate. It's just a matter of degree. And so we really could set a challenge for ourselves of pushing much further to overcome these frictions. But if we do that, then some of the rents that are being earned by these FinTechs are going to dissipate. And in that case, is the venture capital money going to be there? We're not going to see the 10x opportunities perhaps out there that we're going to, and we don't want to see those in the sense that we really want to create services for the households and small businesses. And then maybe the funding of those, we're going to need different funding models. And the good news is that in fact we're developing different funding models. That's a different panel, probably in a different topic, but I think it's a really quite exciting and interesting area potentially for research to think about what those funding models need to be. There's a backlash certainly throughout Silicon Valley, and I think probably it'll spread, if it hasn't already, nationally and internationally. So let me start by saying a little bit about small business lending, because that really hasn't been on the table. I actually think this is one of the big bright spots in FinTech, and I think there's some reasons for that. The borrowers, the small businesses that need to borrow, many of them are really viable credits, and they're just completely underserved by the existing financial system. Partly that's a consequence of regulation, partly that's a consequence of Dodd-Frank. I think many banks made the profit maximizing, probably sensible for them decision given their capital constraints, to move away from small business lending. And FinTech had this big vacuum that it could sort of step into. And it has stepped into that vacuum. It stepped in very efficiently, working with alternative data sets. One of the reasons it's also been able to do that so effectively is that the fair lending laws around small businesses are very different than for consumers. So the regulatory environment is also more embracing of FinTech probably in this space, or at least there's less fear on the part of FinTechs as they've charged into this space. They have also just tremendously rich data that they've been able to use, and they've made great progress. Now, I think when you look at this space as an example, we've learned a lot, and again, there's a host of interesting research questions that have come up from this. I mean, first of all, I think it's now really very apparent. I think this is perhaps not yet received enough focus in the academic literature, that not all data is the same. And the timeliness of the data, the nature of the data is hugely different across these FinTechs. So some of the earlier players that have become the largest in the small business lending space, I think are going to be facing really strong headwinds very soon. And they're monoline businesses, and they're going to be under quite a bit of pressure to diversify and start thinking about alternative products and possibly cross-selling. I think their experiences raise some very interesting questions about sources of market power in this space, and this speaks to the whole algorithmic processing of data and machine learning, and what you really need to gain market power from your data and your algorithms, and how that's going to play out actually for the future of the financial services industry. I think it's actually going to be really at the heart of the relative balance of economic power of the traditional banks versus the big techs that are coming into this space, and FinTechs. And I don't think FinTechs have positioned themselves to have an obvious early mover enormous advantage here. Actually, I think particularly, for example, when you look at the challenger bank space, it's great that they have a few million users, but if banks can pull their act together, so to speak, and we can talk more about this maybe during the Q&A, the way one interacts with the consumer using algorithms and using big data is going to be critical, and challenger banks just don't have that right now. It's way too rudimentary for them to garner the same kind of market power from the resources and data sets that are out there. So we'll see how it plays out. I think there are a lot of interesting questions there to be looked at. There's also a huge amount of disruption going on with regard to the provision of credit entirely in the way we service small businesses. And so some in the FinTech space like to refer to this as the verticalization movement, and the increasing economic moats around good software companies that are going to make traditional lenders or going to challenge traditional lenders. And I think these are going to raise some interesting research and market structure questions. Of course, overall, FinTech lending to SMEs is really pretty small in the grand scheme of bank lending. But it's serving some of the people who would not otherwise be serviced. They're also creating the technology that banks can easily implement themselves through white labeling or developing their own and come back into this space as frictions fall. And we're actually seeing that happening. And so, again, this is, I think, one of the most interesting spaces to be looking at if you think about the question that our moderator posed about what does all this imply for the future landscape of the financial services industry, big tech versus FinTech versus banks. Now, whether we've significantly improved the financial health of households, I think, has been quite a bit more controversial. I actually, as a somewhat neutral academic in this space, I'm fascinated talking with practitioners in the FinTech space on how they line up on that. The breadth of big hearts in this space is really wonderful and fantastic. And an enormous number of these companies are unquestionably trying to do good. But there's also no shortage of judgment among the members of this community, all aspiring for the same enhancements to financial health about whether people have pushed far enough, about whether they've set a high enough bar for themselves, about whether or not they're expropriating too much of the economic rents for themselves versus sharing with the households that they're in fact trying to service. And that's an interesting debate, and it'll be interesting to see how it plays out. Let me talk about one example to make this concrete about where we could have this argument and where, in fact, I'm seeing this argument play out because I've been a participant in or a listener to the arguments unfolding in front of me among practitioners in this space. Consider the problem of lending to thin file borrowers. There's no question FinTech is really improving the access to credit relative, for example, to payday lending, which is a horrendous alternative. But we have to bear in mind that that there are some limitations to this, and maybe we could go further. Let me take a not really hypothetical. It's actually modeled on an actual FinTech and their data and their behavior. The name of the company is not important, so I'll leave it off the table. So we lend to thin file, this company, to thin file borrowers. We use alternative data, and we approach this with a benevolent lens. First of all loans are installment loans. We do an ability to pay analysis before deciding whether or not to issue that loan. When they make payments in a timely way, it gets reported to the credit rating agency, the credit bureaus, so that the credit of these individuals is improved over time. So that's exactly what we want to see in this thin file space, helping people improve their credit, getting access to credit when they need it, and being able, hopefully, to pay back the loan. Now, when people come in the door or go online to, let's say they go online to apply for a loan, over 50% of the applicants are turned down. So there's a selection effect of who applies to begin with, and then over 50% of those that do apply are turned down. So we can't really view this as a pure, wonderful alternative to payday lending. Over 50% of the applicants who even decided to apply are out right at the very beginning. So they still may need credit. They still may be in a bind. They have to go somewhere. So we have to bear that in mind. The way that the pricing works for first-time borrowers is that you price so the pool of first-time borrowers gives a break-even result to the company. So they're not losing money, they're not making money. And you might immediately think, well, how could they stay in business? Well, how do they make money? The way they make money is that they hope there will be repeat borrowers. And when someone has paid back their loan and comes back on a repeat basis to borrow again, they're a better credit, and we know a lot about them. Now, so do the credit bureaus know more about them and know they're a better credit, but there are a lot of frictions in this system. The credit bureaus take time to process this information and to integrate it into an approved score. Time with exposure to credit is one of the factors they consider in increasing your credit score. The banks, or those who might then see the improved credit score and use that for underwriting the loans, tend not to look at alternative data. They're pretty monofocused on and often for regulatory reasons or out of fear of regulatory concerns, on looking at Vantage scores or FICO scores or something like that. So when the repeat borrower comes back, the lending rate, the borrowing rate for that borrower is reduced. They are a better credit. But how much is it reduced? Where should it be reduced to? Well, if in a perfect world where everybody automatically immediately knew that these were now better credits and therefore should be able to borrow from traditional financial institutions at much lower rates, the rates would actually fall precipitously. But the world isn't perfect, and so the rate only falls a little bit. And that wedge between the credit, the true credit, if you'd like, of that individual, the private information about that credit and their actual credit, is what can be used to earn rents, to earn profits for these FinTechs, and that's exactly what's happening. Now, there will be pressures over time to reduce that, but I think that's an issue. And so this is a good way to frame the debate. How do we do that sharing? And how do we think about the need to make profits to service the investors. At the same time, we're trying to improve the lives of individuals. And then finally, the overdraft fee space is another great example. I'll just throw out a forecast, and this may help generate some discussion. We have the technology to make the core products of the Daves, the Bridgets, et cetera, go away. And it's going to happen because we can do overdraft lines of credit, for example, very easily. And indeed, many financial institutions will do this, will offer these. Some won't even tell you they offer them. I've talked to some bank presidents, and they say, we do it, but we don't tell anybody because we're afraid of our own underwriting model. We don't really understand yet how to do the underwriting on this. But anyway, that will become commoditized. This will go away, I think. And I hope it goes away. That's I guess, a wishful forecast. And when it does, I think there's going to be some interesting questions. What's going to be the business model now for these companies? The venture capitalists have invested hundreds of millions, and there's going to be an enormous amount of pressure to generate revenue. There's going to be cross-selling that's going to come from this, new products to move people into more profitable areas where they can build revenue. And is that all going to be good for the consumer? And we're actually seeing this. Just look at the movement away from monoline that we see in the space that Ryan was referring to, the earn-ins, for example, and the new products that they're offering. Are all those really servicing the consumer in the way we want them to be serviced? And then finally, I guess I'll say, I completely endorse the notion that working on the credit side of the balance sheet, for example, can't be the answer. We need to be thinking a lot more about economic empowerment and the space. One of the parts of, it's not really FinTech, it's a blending of FinTech and worker empowerment. It's a growing space. It's an area that I'm personally quite excited about, where we're trying to facilitate access to employment by individuals at the same time we're servicing their financial needs. And there's some very exciting stuff going on in that space that we can talk about in our brainstorming or Q&A if you'd like. Thank you.
All right. Thank you, panelists. That was great. I'll have each of you respond to any general issues you might have heard during the opening remarks. But I just wanted to throw out a couple of things that I think a little bit more clarity would be useful. And you can decide who wants to jump in. So one thing that seems to be an aspect that many of you mentioned relates to the high customer acquisition costs in this market. But if you look at the way the industry is going, there's a lot of unbundling of services, and possibly pricing is also a loss leader sort of pricing. And the question is this something that's going to be profitable, viable for investors, or is this just a small fad that is going to disappear very soon? That would be something to sort of talk about. And related, this came during some of the remarks. When we think about banks themselves and why they haven't jumped into this, part of it could be reluctance to change their technology, but like many of you alluded to, a lot of it has to do with regulation. Now, if we think about the potential for many of the FinTechs and startups to also enter into the gray area where they might end up exploiting biases, like some of you mentioned, regulation is not going to be far behind for these FinTechs too. So how does that puts further pressure on profitability for these FinTechs going in the future? So how do you sort of see all of these things playing from the various lenses that you are sort of looking at this? That would be useful to comment on, and any other thing that you heard that you want to respond to. So in any order now, I guess.
I'd just like to comment on Ken's example with the credit and the fact that some of those FinTech lenders really make money from repeat customers, which I find actually to be a big challenge for them to be sustainable, because a customer comes and he can't get credit elsewhere. They have a better data set. They're able to actually give the money. There is actually a company, Sunbeat. They specialize actually exactly in the problem of my car broke, and they work with car dealers. And when there's no credit card that can actually provide the money, they actually run their engines and they're able to actually provide credit to 90% of the people. So you would think it's a huge success story. It's a lot cheaper than payday lending, but they actually lose money. Where they make money is if that person would keep coming for credit. Now, do we really want them to keep coming for credit, or we want to teach them how to actually manage their finances so they don't have to run for credit in the 90th minute, to use like a sport analogy? So I think that's where they're actually going to be challenged, but I'll stop here.
So I first wanted to double click on a comment that Ken made about the VC model in general. I think one thing that is problematic, in addition to the things that Ken mentioned, is we do have a relatively homogeneous set of entrepreneurs and a similarly homogeneous set of investors, right? And question how well the incentives line up with the customers. And we've really seen FinTech become sort of a Silicon Valley and secondarily sort of a New York, Boston thing, and we've completely ignored the middle of the country when it comes to where smart entrepreneurs are coming from and where venture capital goes. I now spend all this time in Ann Arbor, and you'd be amazed at the kids that are coming up with solutions for family farms, financial solutions for family farms, right? And there are some VCs that are starting to pay attention to other parts of the country and other parts of the globe, but I think in addition to the things that Ken mentioned, that's an important issue to highlight is, who are the inventors, who are the funders, and then who's getting the profits or the rents. They're probably not the users of these products. I mean, on your question on banks and regulation, I mean, FinTechs will often say, right, the two biggest challenges are customer acquisition because it's expensive and regulation. For a long time, there was this misnomer of like FinTechs were unregulated, banks were regulated. There was this big fight. The banks were like, this is so unfair. The FinTechs are unregulated, which is absolutely not true. I do think, right, as you might imagine, and would be the case in any industry where you have a set of incumbents and a set of startups or new entrants, is that the incumbents tend to be more risk averse. So often you hear the example in this industry of anti-money laundering or know your customer, AML, KYC. Regulators, incumbents, consumers, everybody agrees that the system we have now, at least in the US, is wretched and does not work for weeding out bad actors. In fact, it's much better at like weeding out people who need access to the financial system and now can't get it because of AML regulations. Banks, I once represented a bank who allowed a transaction for somebody on the OFAC list that was like a $1,200 transaction. Not a good thing by any means, right? If you're on the OFAC list, you should not get US dollars for sure. But it's a $1,200 transaction and the fine was in the 9 figures, right? So it just means that if some poor soul who really needs access to the financial system happens to have the same name as somebody on the OFAC list, the bank is not going to take a chance in providing banking services to that person. I think FinTechs tend to be less risk averse, as you might imagine innovators to be, one, because there's not sort of the same dollar and reputational things at stake, but also just because they have, I think, a better ability, and the culture is such that they often are and should be more willing to sort of go in and chat with the regulator. So one thing that we did in my company, we used machine learning to underwrite title. Was not contemplated in any of the regs, even though every other type of insurance uses predictive analytics to underwrite. Title insurance does not. All the regs in every state require a search, which the regulators read to mean you have to go to the property or to the county property records and search the property records. And we said, well, look, if you can use data analytics to search hundreds of data points, isn't that actually a more robust search than looking at 5 pieces of paper in the county register's office, right? And we got the regulators to agree to that. But I think if you're a startup or a FinTech, you have much more of an ability to go and have that conversation than if you're an incumbent. But I do think as FinTechs become more like incumbents, or FinTech is more a big tech phenomenon than a startup phenomenon, some of that that risk-taking appetite may become less.
So yeah, I thought it was a really interesting discussion. There's, I think, a lot of points to go down. I think one thing, just to maybe start on venture as an asset class, because venture is an asset class. It is an asset class that requires an allocator to have billions and billions of dollars. For this to make sense, like as an organic idea that I'm going to invest in early stage startups, this is maybe 1 or 2% of our portfolio. I mean, you guys know this better than I, but it shouldn't be this huge thing. And so part of the reason you see this disparity of venture in the coastal areas is because that's where these pools of money are kind of designed to funnel the cash to. Like, they're not really designed to funnel huge amounts of cash to Ann Arbor, Michigan. Unfortunately, it's actually designed to take money from Ann Arbor, Michigan, and funnel it the other way. And so that makes it really difficult to do very capital-intensive businesses outside of these coastal areas. Because if you know that a business is going to require $500 million or $1 billion of capital over the next 10 years, you want that business to get into a capital center as quickly as possible. And that I think is part of the pull here away from some of the central. I don't know if it's necessarily a bias in favor as much as it's a pull towards. Especially as these businesses become more successful, the pull is to have the founder come to a capital center. And it's not just in financial services. I think you see this in almost every business that taps into venture. I do think there's a related point here, though, that Professor Singleton was bringing up around if this is the appropriate source of capital for many of these businesses. I do not think this is a good source of capital for any business that's using capital as its business. If you're making money off of money, so lending, insurance, if you're manufacturing a product in the financial services parlance, I think there's a big comeuppance that will happen once these businesses get to a certain degree of scale. And so far, the track record of these companies that have managed to go public has not been good. And I think that's going to continue. And I don't think it's just in lending businesses. I think it's probably in insurance. I think it's anything where you've got a business that, at the end of the day, you're selling capital. Because if you're selling capital, it's way better to buy that capital from the federal government, who pays you to have it, if you deal with having a regulator show up all the time and maybe employ several tens of thousands of people to deal with them, than to have to go borrow it on the open market. And if you look at like the innovation in the space, I mean, we stay away from lending businesses, and I think we have to deal with the fact that oftentimes we look totally wrong immediately because these businesses can grow so fast, and they instantly raise more money at higher valuations. And you just look like an idiot, honestly, because you're like, oh, I obviously should invest in that business. But the problem is they're not growing like a venture-backed business. They're selling money, and it's the easiest product in the world to sell. And so yeah, you grow really, really fast, but you don't grow fast enough to have market power with the capital. And I think that catches up to these companies when they go public, and public investors sit there and say, hey, all right, Lending Club, you went public just looked it up, at a 30x multiple to revenue. And now it's trading at a 5x multiple of revenue. It's gonna come back down because that's what lending businesses trade at. Partly because there's no examples of lending businesses surviving a cycle. Because once the capital markets freeze up, the capital goes away, you can't sell your product, and your company fails. And I think that public investors pick that up. Venture investors are basically betting that that's not gonna happen before the company goes public and I can get liquidity. And so I do agree that that's part of why you see so little innovation around lending businesses. But I don't know if you want to paint as broad of a brush to all fintech. I think that many of the things that people get excited about and talk about, and frankly, like I think why many banks are not real competitive threats, is they see these businesses as design innovations. It's like, whatever, it's an app, doesn't matter. It's just a different color. It's the exact same product. We could do that too. The reality is that they can't do that too, because the design innovation is the innovation. Many of these fintech products that have scale are retail products. So there's a manufacturer, which could be a bank, there could be distributors, could be other banks, other financial institutions in there that are helping to make this product happen. But at the end of the day, the good ones are simply selling almost a finished product, and they're selling it at a much cheaper cost than any incumbent can get close to. We have companies in our portfolio that are acquiring customers at millions of customer scale for single dollars. Then we have other companies in the portfolio that think they're doing really, really well that are paying $50 for the same customers. The advantage that one of these companies gets when they really get that flywheel spinning is so extreme that I do think it creates competitive advantages over the long term and warrants tech-like valuations. And the other thing that warrants tech-like valuations are SaaS businesses, where you're getting paid a subscription fee, similar to like a Netflix or Amazon Prime, whatever it is. Those SaaS businesses are incredibly lucrative because at scale, they provide, you focus a lot on contribution margin. Because if you can get a high enough contribution margin, you can almost indefinitely invest in R&D, more so than any other competitor can. And that, I think, is where there's some really exciting stuff on the consumer side, because there aren't banks that are sitting there saying, I'm going to create an overdraft protection product or a savings product for the 150 million Americans in this country that aren't worth anything as checking account customers. Like, they don't want those customers. And so those products, I think, are where you do see a lot of innovation. I think and I do think you'll see venture-style returns, but I do agree that this is a relatively small sliver of what is called fintech.
Well, nothing's cheaper for lending, right, than deposits. Right. So while those things are intertwined, right, that proves your point.
I think Ryan mentioned briefly the idea of the cycle, the next cycle, when the cycle ends. So I know there are a lot more asset pricing people in the room than I would ever pretend to be. But I bet some people at least think that the stock market is a bit crazy and that things are priced in a way that we could be at the end of the cycle. Now, I don't have a crystal ball. This is not my expertise. But I don't think anybody here would be shocked if over the next couple of years we'll see some type of a correction, and we'll see that there's no money just because of a little bit of the psychology. There won't be any money for fintechs, and most of them operate, you know this better than me, on 18 months, 2-year rounds of a raise. So I think a lot of the future of fintech would actually be related to the cycle, because if we hit a bad cycle in the next 6 months, many of them would not be able to actually go through it. So I think there would be a big question mark to where that entire industry goes.
Yeah, I guess I'll come back to Amit's question in a minute, but just to follow up on that point. Certainly I see in my engagements with venture capital a strong reluctance to go anywhere near fintechs that have a big balance sheet component to their product line. And so I think that's a really tough entry point right now to get funding in the fintech space. And I think it's those firms that are likely to be most sensitive to the cycle. And I think it's not merely that they have the balance sheet intensive business, but whatever their underwriting models are, they've all been developed with alternative data over the last handful or 2 handfuls of years. And we haven't seen a downturn. So one should reasonably be suspicious about the quality of these underwriting models, because they simply haven't been tested. And we don't really know how valuable a lot of this alternative data is going to be in downturns. In some of these product lines, I'm actually quite confident that the data is quite valuable and informative. And some of them, just by virtue of the innovation itself, are actually providing some insurance for this. I mean, a very simple example, which I like, is the loan product coming out of Square Capital, for example, where the small business borrowers are paying back a percentage of their monthly cash flow. Well, if the cash flow falls off, so do their monthly payments. So they're basically getting not only a loan, but they're getting insurance against weak quarters or months in their payment processing. And so both sides, I think, will probably benefit from that in the sense it's going to lower their credit risk. But I think there are big questions about the next cycle. Amit raised the question about regulation and it possibly creeping in here. I think one of the things we need to put on the table is that virtually all fintech, when it wanders into the regulatory space, needs help, and they rent compliance. They basically put a bank in the background. You've all seen that in the fine print of virtually every fintech. There's a bank in the background if they're doing anything related to deposit services and or lending. There's almost always a bank in the background. And that's going to change. And I think as that changes, it's going to be very interesting to see how that changes. Are we going to see the ILCs, the industrial loan charters, start being granted to fintechs directly? Several have applied. It's been a very political hot potato. We'll see how that plays out. In which case, then fintechs will be directly responsible for the dealing with the regulatory issues, or are we not going to see that? I think regulators are going to have to get down the learning curve much more than they are, because some of these underwriting models and or business models are using machine learning, for example, in rather sophisticated ways, and they're passing the recommendations onto the banks in the background that are ultimately, and the FDIC has already ruled on this, are ultimately responsible for the products that go out the door. Even though we don't know they came from Bank X is actually responsible for those products. Their name is on it from a legal point of view. And many of those banks, frankly, don't understand the models being used to generate the products that they're responsible for. And I don't really have a good sense, maybe you do, about how much the regulators really appreciate that, and have they really assessed the extent of the risk in the system, especially in light of Shlomo's comment about what happens in the next downturn.
Yeah, well, I know we want to probably move on to some other questions, but I think you're absolutely right. The regulators are not quite up to speed. They're trying, but by definition, right, the regulators are never going to be as far along as the innovators. As an aside, I tend to think that's in some ways a good thing, right? You don't want them to lag so far behind, but you also don't want them to front run innovators. But they certainly could be closer in keeping with what innovators are doing. People, at least in the US, FSOC did start looking at sort of systemic risk when it comes to fintech, and in particular, fintech lending. And sort of determine that it's such a small fraction of lending. I think ditto digital currency, people feel like it's such a small piece of the overall pie. But I agree with you. I'm not sure regulators are sufficiently up to speed to really make a good assessment of that. And part of that is a talent issue, right? Like if you're a data scientist, you'd probably much rather go and be a part of one of Ryan's startups than you would want to go to the SEC.
So I think it's time for opening the questions to the audience, but I just want to clarify one thing. When I was saying that fintechs are going to face more regulation, I didn't mean that they don't face any regulation. What I'm sort of getting at is the following notion that right now, a lot of the discussion has been that tech is good, but we know that there are opportunities here to also do bad things. There's data, there's machine learning. We know that not all data and not all machine learning necessarily leads to good things. And the question is, when the regulators do catch up and those costs start getting imposed on fintechs, does that make the model possibly less viable than what they're facing right now? So that's what I had in mind. But related to that, like on data and privacy, none of you sort of really mentioned anything on that, but that's something that's coming. Is that something that you expect to change the way some of these models stay viable or not viable? And then we can open up for questions if any of you wanted to comment on that.
Just two quick responses. Yes. The U.S. is behind, I think, the rest of the world in terms of privacy rules. States are taking the initiative to step in. California, for example, has a very strong data privacy rule that's about to go into effect, and we'll see more in the country. I personally would like to see a more thoughtful, coherent strategy on the part of our regulators here in the U.S. on this issue, rather than largely delegating it to the financial services industry as they have done so far. I think that disadvantages the ultimate users and also probably puts the U.S. financial system at somewhat of a disadvantage relative to the rest of the world. On a more optimistic note, because the rest of the world has moved more aggressively on this data privacy, and many of our financial institutions are global in nature, they are being forced to develop systems that comply with the rest of the world's requirements, and some of that is filtering into the U.S., and I think that's a good thing. Much more speculatively, I'm actually quite excited about the prospect of FinTech, or some tech, may not be called FinTech, developing business models that actually allow individuals and small businesses to control and monetize their own data, rather than transferring all of those rents from the value of the data itself to those that are collecting the data. It's been a really hard problem. There are a few companies here in the US that are dabbling in this area. There's a UK company that's been trying to make some inroads in this space. Very early days, but it'll be very interesting to see how that plays out.
I think just a couple of points here. I agree with everything Ken has said, and part of what's great about federalism is you get this state experimentation. You get California getting out in front. The bad part of it is none of these companies have borders, right? Money doesn't have a border, and so the fact that if you live in Nebraska, your protections would be different than if you live in California, right? And companies are trying to figure this out is problematic. So I think national policymakers need to move much more quickly and aggressively on this. The other issue that often comes up in discussions like this around data is discrimination, right? And we saw this with the example of Facebook and who they were advertising to and who they weren't, but the issues around the use of data and discrimination are sort of endless. This issue about monetizing data, I think, is an interesting one. I think if you think about now, like I always joke, if somebody were to look at my Google data, like I'm pretty certain that Google thinks I'm 60 years old and white, and like you actually think about like the accuracy of the data that Google has on you, it very often is highly inaccurate. And so the idea that a consumer or a business could pick and choose which information they use, or be able to sort of insert certain information into the ether to be used for a particular purpose and then withdraw it from the system is one of the use cases people talk about for blockchain, and the analogy is often your license, right? If you're a college kid or a grad student, you go to buy alcohol from the convenience store, you give your license to show that you're 21 or over, but in fact you're providing the clerk with far more information than they need to make the determination about whether they can sell you alcohol or not. Really, they don't even need to know your exact age, they just need to know if it's 21 or over or not, but they don't need your address and your eye color and your height and all of that. I think the selling data idea is very interesting. The thing I worry about is who is going to sell their data and who can afford not to sell their data. And in some ways it makes me think about like the reason why we don't allow people to sell their organs, right? Is because you'd have a bunch of rich people walking around with like, I got 2 great kidneys, like I don't understand what the problem is, right? And people who are financially struggling walking around with like, I got half a kidney because I had to sell the others that I had. So I think there's a lot to be said in exploring selling consumer data, but if the regulators don't keep pace, we're going to find ourselves with only certain people selling their data. The data then becomes skewed, and then some of us being able to afford to not sell our data, and that's going to have another set of problems that I don't think regulators have even begun to think about.
I will say, just I know we're on time, but I would be very surprised if a federal kind of data privacy regime or some sort of GDPR in the U.S. disadvantaged fintech startups vis-a-vis the incumbents. Like I think that I would, as an investor, that'd be great. I'm 100% in favor of that. You just think about data as like in a boat or something. The incumbents are sitting on so much data and it's leaking out all the time that it would just be such a harder lift for them to comply with than a new company getting started. And I think that the model is not going to be JP Morgan or Bank of America and making sure that they're complying with that. It's going to be Facebook and Google, and the ability of those companies to respond to the regime is just much stronger than I think your banks would. And so I would be kind of pretty bullish on tech's ability in that environment if that were the case.
I think we can open up the for questions. So you'll have to stand up and speak up, and I'll probably have to relay that again in the mic just so that it gets recorded. Please.
One of the companies that Ryan described was Dave.com, which I understand extends credit under certain circumstances. In light of the comments of your co-panelists, can you tell us what effective interest rate they charge when they do extend credit?
So Dave doesn't extend credit. Dave advances consumers money. It's non-recourse. So if the person doesn't pay them back, there's nothing Dave can do except for not lend to them again. And so they would, I think if they were here, their lawyers were here, they would say they're not in the credit provisioning business. The effective interest rate would really vary if we assumed it based on kind of how much, because what it's doing is basically, I'm going to look at your account, and if you're going to have an overdraft, giving you the option. So first I'm charging you $1 a month to just look at the account. And whether you overdraw or not, that's kind of the subscription fee you pay. And then if I spot that you're going to have an overdraft, I say, hey, you are likely to have an overdraft in the next day. Do you want us to advance you up to $75 to avoid that? And then if you said yes, you can get the $75 the next day, which I believe is free. Don't quote, I have to check their terms, but I believe it's free the next day. If you can wait 4 hours, I think it's like $1 or $2. And if you want it right now, it's like $4 or $5. And those are fees which are being paid to another service provider to kind of get that money out. So obviously there's some sort of markup there. And then at the end of the time after they've taken the money back from you, which is usually only a couple of days, you can give them a tip, and that obviously varies depending on what the person, how much they tip, but yeah, probably a couple dollars or some percentage of it. And so it's really hard to figure out what the APR for that product is. I know the team at Dave has been working with, there's some legislation in California to try to bring some more clarity to the space, and they've been kind of working on that to try to kind of just identify what they think that would look like. But going to kind of the point that Adrian made about that environment is if I'm advancing you $10 and you're going to use this for 2 days and you're going to pay me back $11, that APR is obviously astronomical. But that's probably not the best way to think about that transaction. I think that's how the Dave guys would argue.
Just to add a little bit of commentary on that, I agree with everything Ryan said. We have to be a little bit mindful of the limitations of APR when we're scaling up very short-term payments to annualized numbers. Having said that, the regulators are concerned about, I guess, the implicit concern in your question, and if you're interested in this, you can read about the case of what used to be active hours, now earn in, where the New York State Attorney General has raised questions about whether they're not a payday lender in disguise for making similar kinds of advances, and are considering or were considering some regulatory enforcement, and that's public and in the press. You can read about that.
Other questions?
Can I comment quickly? Sure. I think echoing both what Ken and Ryan said, I mean, this is where the classic regulatory regimes, right, APR goes off the rail, or even if you think about this, the investigation in Earn It and the legislation in California with Dave, I think there is this muscle memory in policy making and regulation, and I will say often you find it more in progressive states that should be sort of thinking more about innovation and consumer financial health along with consumer protection. To think, what's the APR when actually it's, an extra $1 and actually APR is not the best measure, or, is it tip-based? Well, then it must, they're very skeptical of the tip-based model of an earn-in, even though earn-in, like Dave, is non-recourse, right? And so there's an education gap here, but there's also, I think, for some regulators, and I've, both been in entities regulated by New York DFS and worked with them on the policymaker side. So I don't mean to single them out or California. But I think it's really important for regulators and policymakers to get into the details because there is so much innovation and all of these companies, right, Dave and Earnin and PayActive, like they're all in the same space but doing things a little bit differently. And, you know, policy is a broad tool, right? You have to sort of deal with things in the abstract, but when you get this innovation happening and these tiny little tweaks in the business model, you do run the risk of regulating out of the market tools that could potentially be very helpful for consumers. And so I think, again, finding this balance between the regulator's job of consumer protection, right? We might not think the regulator's job is financial health. Maybe the policymaker's job is thinking about financial health. But I do think regulators need to, and policymakers need to think about how to find that balance of, yes, maintaining their mandate of consumer protection, but also thinking about financial health and not moving so quickly that they don't allow some of these innovations to gain a little bit of steam and actually look at the data and see what benefits they might be having for consumers.
All right. Since there seem to be no questions, there is, okay. Yes, please.
We have 25 minutes to go. I thought I'd
Yes.
ask an additional question. Do you see other areas of the life cycle being ripe for innovation in terms of fintechs? Had I wandered into this, I would have thought that fintech is about debt management and how to pay less debt and less interest and smoothing consumption. Are there other points, you know, fintech to help me minimize my taxes, tax inefficiencies, or fintechs, you know, better life insurance? I'm just curious your thoughts on that.
I might jump in. I think a lot of people would have opinions here, but if you, the way I naively talk about the savings side, that we've got millennials in Silicon Valley and Silicon Beach building companies for other millennials to save money for retirement. And I think that would be true of the Acorns and the Digits and others. Nobody is catering to the baby boomers. So when I think about the life cycle, and that's an area I'm actually very interested in, we virtually have all the baby boomers retiring and nobody is really helping them make the most of their money. So you hear stories about people with lots of liquid assets who take their daily medication on Monday and Wednesday only because it's not easy to figure out the math that actually you have enough, and vice versa on people who. So I think that to me is probably a big missing part in where we actually see innovations.
Yeah, I would say fintech really is growing up. I think it started a lot in lending and payments and savings, and as the funding has become more available, as the industry has matured, as it used to be sort of more tech than fin, and over time it's become more fin as much as tech, so you get more people with a financial services background and not just tech people who'd like never worked in a big bank, so you see more of that blending. It has gotten into these other areas. I mean, you have Policy Genius, it's sort of it's an insurance agent, but a recommendation engine for life insurance and auto, right? Takes some of your data, helps you find the cheapest policy. For you, you've got SigFig, which was a retirement product that was aimed at baby boomers, or is aimed at baby boomers, helping them think about the drawdown of their retirement savings. There's some companies out there that help seniors think about when they might want to sell their life insurance policy, right? So you're older, your kids are grown, they're like pretty well set. The payout is not as meaningful, like you should sell it, take the money, right? Similarly, you see things popping up around reverse mortgage for the same population. So I think fintech is getting there. It's just that so much of the low-hanging fruit and so many of the problems with financial health happen around debt and savings and retirement. But I do think the industry is sort of graduating to these sort of other sets of problems.
Yeah, and I think Adrian made a really good point, made a number of really good points there. But I mean, the overarching one is, you know, we're in, I think someone said we're 10 years or so after you can have mass adoption of mobile computing. And those were kind of the easiest things to bring real design innovation around. That demographic generally has tended to trend younger. It's one of the reasons that the banks kind of dismissed a lot of this, because they were like, these are just a bunch of kids. I don't even want these people. They have no money. There's a bunch of kids with no money. Who cares? And I think they kind of conflated the fact that younger people were using technology with the fact that people were using technology. And so as you've seen more older Americans become much more comfortable using a device, I mean, I would be really surprised if my own father would put his banking credentials into his phone a couple of years ago. Like, he absolutely would not have done it a couple of years ago. Now I think he probably would. Next year, I think he probably would feel comfortable doing it. I mean, you have to get comfortable with that first. Where you're gonna say, I'm gonna give this app access to my bank. And there just aren't as many older Americans who feel comfortable doing that or felt comfortable doing that years ago. You also have there's the point I think you made about the youth of many founders just kind of being oblivious to those problems. That's starting to change too, in part because if you're gonna create a fintech product for baby boomers, that's an incredibly wealthy demographic. They're very hard to reach. They're super entrenched in what they're doing already. And so you're gonna need a ton of money. And that's not the kind of startup that you want a 22-year-old running. So you generally kind of need startup founders to get a little bit further along where you're gonna kind of trust them with these ideas. And you think about Estates Title was a very experienced CEO, operator, started that business. Lemonade, those guys had a tremendous track record before they started it. So I think in these bigger, kind of obviously large market capital intensive businesses, you kind of do need founders who've been around the block a couple times where you're gonna feel comfortable in trusting them to build this. But I do see that definitely changing. The other two ones that I would flag would be innovations around the payment system. I think many people are kind of waiting for the Federal Reserve to do real-time payments. My money is some startup will figure out how to do that faster, cheaper, better than the Fed. And will kind of obviate the need of it because that's just such a huge opportunity, and again would require significant amount of technology. And I think that you're starting to see some startups that have almost kind of created this kind of tokenized payment feature as a derivative element of their core product. Acorns is a great example. If you've already set up Acorns to sweep money from your account, and Acorns has 6 million people who have linked their accounts to, at this point, probably hundreds or thousands of banks in this country, they're running their own ledger of all the money in the accounts. For them to be able then to allow you to spend that money on different platforms, I mean, that's a regulatory compliance question, but it's no longer really a technology feasibility question. And so I think you'll start seeing stuff like that, where maybe some of these derivative products where, an Acorn says, well, hey, you can pay your credit card bill. Seem like, okay, well, a nice feature, but in reality, that's an incredibly complex product to build. And if they can get, a couple pennies out of that transaction, I mean, that could be a significant business. And then the other kind of big trend is, and I think if you talk to, a lot of venture capitalists in fintech, there's going to be kind of fintech everywhere, which I don't think doesn't make a tremendous amount of sense to me, but the idea that you're going to embed fintech products in a whole host of other things. So there's going to be like a Sweet Greens credit card that allows you to buy salad or something, but then you can advance money out of the product. And you're seeing a lot of kind of infrastructure businesses now that are enabling all sorts of kind of mostly consumer businesses so far, to embed fintech products into it. There's a lot on, I think the Square and the Stripe examples of how much they've been able to build by kind of getting the, kind of the catcher's mitt of a payment, I think has inspired a lot of other companies to look at that too. And so I think you'll see a lot more in that space.
So just following up on the comments of my fellow panelists, actually when I developed a FinTech course for the Stanford MBA's sort of innovative financial inclusion, and the way I teach this, and in partly actually the way I integrate the behavioral finance into the course, is to actually start with a classic life cycle model from economics, and then sprinkle fintechs all the way along the entire life cycle. And there's been a massive amount of innovation at every stage. So the early phases of the life cycle, for example, where people are incurring debt to build up human capital. So there's a massive growth in the student lending space right now about ways to facilitate that, ways to recapture, consolidate, pay off your debt in a more friendly way, different models for taking out student debt. We've been talking about the lending and payment spaces. There's a lot in liquidity management, tax management, insurance, which are not actually literally considered part of FinTech narrowly. It depends on what you think about FinTech. And there's a lot going on in two other areas we haven't touched on at all. One is liquidity late in life. So for example, being able to bring some liquidity to your home without having to give up the right to live in your home. A very large number of companies have started up in that space right now, many here in the Bay Area, some using blockchain, some not, but very innovative in the technological structure of these products, and also the regulatory, legal structure of these products because of what's involved with way homes are recorded, et cetera, in the US. And then finally, there's a growing amount of innovation in what we might call the longevity space. The statistics there are just staggering for someone my age. If you look at the percentage of the US population expected to comfortably live past 100 going forward, it's very high for people who were born not too long ago. And so there's a lot of innovation going on in that space right now, both from the point of view of protecting and avoiding fraud for the elderly with financial products, but also worker activities and placement, so sort of the economic empowerment side, but also investing savings and other products to use to stretch out your retirement money given that longevity. So at both ends of the life cycle, there's a lot of innovation going on.
And I would say, don't forget too, I mean, we've talked mostly about consumer finance, but financial services is about more than just consumers, right? I mean, one of the reasons why I've always been drawn to financial services in my career is because there's very little else, probably nothing else that happens in an economy without a financial services provider somewhere in the supply chain. So FinTech is not just about consumer finance, but we think about, you know, equipment financing for manufacturers, lending for renewable energy products, and how you can make that more innovative through things like blockchain or other sort of FinTech innovations, right? So the space is incredibly broad. And I think we're going to just see more and more of sort of FinTech infiltrating other industries, right, outside of pure financial services like manufacturing, like farming, things like that.
Can you talk a little bit about some of the unintended consequences that might be possible with FinTech? They scale very fast, they get big. To the extent there is a law or zoning error or some sort of bad recommendation, that can propagate much faster into the economy. And a recent example of Robinhood brokerage, you know, recently widely regulated fee by allowing leverage much greater than was permissible regulatorily because of COVID. So I don't know if you want to comment about that or other general ideas.
I'm not the expert on this, but one of the things that I've seen is the issue of cybersecurity. So that would be a big issue because, at least in the space I'm most familiar with, retirement savings, you do see attempts to go and virtually steal, you know, $500,000 accounts from the traditional players, kind of, you know, the Fidelity, Vanguards, T-Rows of the world. And that cost them a fortune. I mean, protecting those accounts cost a fortune. And when you look at the FinTech industry, at least the limited experience I've had, at a very early stage, it's not an issue because there aren't kind of these big accounts to steal. But then they become successful, and now they become a target. And that's where actually some of them realize that it costs a lot more money than they thought to actually have the right systems and protections. So I wouldn't be surprised if there will be like gaps when a FinTech is actually becoming successful, before they become a big company, that there's a weaker link there, and that, you know, there'll be a lot of cybersecurity fraud at some, you know, new scale.
You know, I think that most, I mean, your question is a really interesting one, you know, around unintended consequences. I mean, I think the fact that there's a business failure risk in these businesses, like any business, is probably not what you're getting at. But the fraud environment here is so intense that once these, instantaneously upon launching, these startups are bombarded with the sophisticated frauds that affect every other kind of incumbent. And some of them fail in that environment. But coding error, shuts down thing at some point in that environment. If that had gotten out of hand, Robinhood's prime broker would have just pulled the plug on it and Robinhood would have failed. And that would kind of be the end of it. Because so many of these guys their retail products are not really in the manufacture. I don't know if they present the same systematic risk that a financial institution does when they're putting together CDO products that are kind of at the heart of what's happening. I do think one unintended consequence is a little bit of, Adrian made this point earlier, which is actually, I think, kind of cuts both ways about the data analyst at the SEC that comes and gets a job at a startup. You really are seeing a bit of a brain drain out of these regulators, especially younger staff, into startups. And I think the focus is so much, if you read the news or the banking publications or tech publications, it kind of treats the financial services industry like there's FinTech over here, and then there's 4 banks over here. There's 15,000 other regulated financial institutions in this country. And increasingly, you're having a regime that's saying, well, how do we do data privacy, and how do we kind of make sure we're managing systemic risk? And you don't really get the sense that people are paying that much attention to the middle of this barbell. And that's where I think you probably have some of the more kind of unintended kind of consequences popping up.
Yeah, and I would just make one, it's a different sort of unintended consequence than what you're getting at, but I think all of this innovation just makes money less tangible, right? And there's endless studies about how people think very differently about money when they're counting out dollar bills versus when they're swiping the card versus, right, when you don't even have to stop at a register. You can just pick up your thing and your geolocator, right, does the thing, and you walk out of the store. So I think one of the maybe more meta unintended consequences is how do we think about money and value when we're never seeing money, right, when there's no action required by us, not even so much as a tap or a swipe, and what does that mean for the way we think about money and value and financial health?
There's this is actually a little different than the question you asked, but the answers to your question actually led me to think about this. We haven't throughout this entire panel, partly because of the focus on households mostly and the ultimate users and their financial health, talked very deeply about if you are a balance sheet based FinTech, how you fund yourself. And there's been an enormous amount of innovation in funding structures for the FinTechs themselves to be able to issue product, loans, et cetera. And it's corresponded with the massive growth in private debt markets in the US, which many people have been reading about. And one of the consequences of this that has a more positive light on it, I think, is that we have, as we've moved a lot of this activity outside of the traditional banking system, it's a much greater distributed ownership of or exposure to the debts in much less concentration through the traditional banking system. You could be worried about that from a regulatory point of view. You could be encouraged by that from the perspective of a potential reduction in the amount of systemic risk in the system. There's open debate about how far removed the traditional banking system really is from this, how much they're providing lines of credit to exactly those companies that are building the debt facilities to fund some of the FinTechs, et cetera, and people come down on both sides of that. But I think on the whole, the moving away from the traditional banking system, in some ways, at least on this underlying ownership or exposure to the debts in the country, are probably much more distributed than they were prior to the innovation in FinTech.
As Professor Singleton mentioned, the FinTech companies may take excessive economic rent by exploiting their user-based historical data and the increasing market power in certain areas. And also there is always a trade-off between the consumer financial inclusion and financial protection. Some data are good, some data are bad. So how can we push the development of FinTech towards the direction of the optimal social welfare?
I don't know if that's intended for me or not. My name was mentioned in, in the question. So the question on the table is there's ample room for exploitation within the FinTech space, and how do we move in the direction of ensuring that the well-being of those being served is first and foremost in the decisions we make. I think this is going to be a massively important and challenging issue over the coming years, partly because of the algorithmic big data world that we're moving to. There are, on the encouraging front, there are initiatives to enforce consumer Bill of Rights. Organizations are actually drafting principles of practice for FinTechs and asking them to countersign these Bill of Rights for consumers. So it's a little bit in the spirit of self-regulation, but it's backed up a little bit by money in the sense that some of the proponents of these Bills of Rights are actually also actively involved in building the credit facilities that are funding the FinTechs and therefore making it possible for them to develop and move forward with their business models. And so there's a synergy there that's positive and favorable towards the user. Not everybody's buying into these and subscribing to these. I think regulators are going to need to do a lot more, and we need to know a lot more about protecting the consumer as data becomes more widely collected, available, and processed, and presented to users in ways that can easily, in the spirit of all the research Shlomo has done, nudge people to make decisions that might not be in their best interest, but just by virtue of the way it's presented to them, they're possibly led down a non-productive path. And I think that's just going to be a massive challenge, and we need to be working, regulators need to be thinking much more about that than probably they are, and developing the human capital to do that. It's a big issue, though. I worry about that.
Okay, I think we've run out of time, and with that, I'd like to thank all four panelists, and let us give them a round of applause. Thank you.